Good afternoon, everyone. It's my great pleasure to address the second AMRO Forum. Today's topic on debt and financial distress is both old and new. It's an old topic because Asia is no stranger to financial imbalances, which ended up as the painful consequences of the Asian financial crisis. But fortunately, the region has learned the crisis lessons well and went to great lengths to improve our resilience, including accumulation of sizable FX reserve, and also lessening of the original SIM problem through the development of local currency bond markets. At the same time, we've made concerted efforts under the auspices of ASEAN Plus 3 in order that we can provide regional financial safety nets, such as the Chiang Mai Initiative Multilateralization, or CMIM, which greatly enhances the region's liquidity pool. In fact, Asia's remarkable resilience to the pandemic shock and to the global monetary tightening more recently speaks volumes about the region's soundness. Nevertheless, today's topic also carries new significance to Asia. In the aftermath of the pandemic shock, both the public and the private sectors in the region have accumulated a sizable amount of debt, with corporate and household debt reaching historically high levels in some economies. Moreover, structural factors such as population aging will likely pose upward pressure on public debt levels going forward, and that is exposing the region to three challenges. First is the higher for longer global interest rate environment. Following the aggressive interest rate hike by the US Fed, Asia's interest rate differential relative to the US have widened, adding to FX and fund outflow pressures in the region. They constrain any policy easing by regional central banks. Along with fund outflows and also the tightening global financial conditions, regional credit financing has become more expensive as well. So far, partly because of strengthened cash buffers in the private sector, we are not seeing pervasive signs of financial stress, and credit quality only deteriorated moderately. That being said, the higher for longer global interest rate setting means that any near-term refinancing needs will have to be met at a higher cost, and credit quality may continue to face deterioration pressures down the road. The second challenge is the hidden vulnerabilities in non-bank financial institutions, or NBFIs. One notable example is the Asian private credit market, which has grown over by almost 30 times over the past 2 decades to more than $90 billion as of the middle of last year, according to an IOSCO report. Our study finds that borrowers were riskier, for example, more levered, and could be hit hard by the higher for longer interest rate environment. A source of comfort is that bank funding to private credit lenders in Asia is small, which should help contain the spillover risk from private credit to the banking system. Highly leveraged NBFIs, for example hedge funds, are another area of concern, as their high leverage and market linkages can amplify liquidity stress. The third challenge is the sovereign bank nexus. As public debt levels in the region are on the rise, emerging market Asia's banks also increase their holdings of domestic government bonds. If government finances come under pressure and the market value of government debt decline abruptly, these banks could suffer from considerable losses that erode their capital buffers. While our assessment so far is that such sovereign bank nexus problem is relatively contained for Asia when compared to other emerging market economies, the situation requires our continued attention. By now, I hope that I have convinced you all of the need to stay vigilant to these three debt-related challenges facing the region. To round off my discussion on a more positive note, I'm going to suggest also 3 action points that can help the region fend off some of these challenges. The first action point is to enhance the resilience of the region. As I mentioned earlier, the risk of a sovereign bank nexus, while contained, cannot be overlooked. To this end, banking supervisors have to conduct more frequent and comprehensive asset quality reviews on banks, including both various debt portfolios and credit exposure backed by public sector guarantees. Meanwhile, our macro financial stability framework needs to continue to deploy different policy tools in a consistent and complementary manner with very clear communications. It is also important to ensure fiscal sustainability and also maintain adequate buffers so as to anchor market confidence. In addition, by further broadening the domestic long-term investor base, for example through the ASEAN+3 Asian Bond Market Initiative or ABMI, the region can become more resilient in the face of outflow pressures, given that domestic long-term investors are usually less flighty than foreign investors during market stress. Relatedly, our study also finds that deepening the FX derivative market in the region could be one way to make foreign capital flows less flighty by fulfilling the foreign investors' hedging need. The second action point is to promote the development of sustainable and transition finance. By doing that, we not only help the region achieve a more sustainable economic growth model and help the world decarbonize, but also that will help attract long-term investments to the region and reduce fund flow volatility. Another HKMA study finds that equity ETF with ESG attributes tend to experience smaller fund outflows in response to macro financial shocks as compared to those ETF without those ESG attributes. In a further study, we find that long-term investors who tend to invest in ESG funds are less sensitive to macro financial developments. In fact, the share of ESG ETF in terms of market value is still very low across the region when compared with some advanced economies, thereby suggesting that there is further room to promote ESG funds in the region. The third action point is to foster even deeper regional cooperation. As I mentioned earlier, the CMIM, the Chiang Mai Initiative, as a regional safety net is perhaps the epitome of regional collaborative effort towards strengthening the region's shock-absorbing capacity. As another example, the ABMI has also made great strides in broadening the domestic investor base and mitigating the original sin problem facing AMRO-Asia. Going forward, I believe it is worthwhile to devote even more efforts towards both initiatives by priming the CMIM further such that it can be more attractive and readily deployed in case of emergencies, and also further expanding the ABMI so that Asia's share of intra-regional portfolio debt investments can be brought up to a level commensurate with the intra-regional trade share. Last but not least, we need to address data and knowledge gaps. NBFIs could represent an emerging source of vulnerabilities, and the gauging of the extent of NBFI is complicated by the lack of transparency of NBFIs and data gaps. At the HKMA, we have developed a surveillance framework, and our experience is that we can narrow the data gap by using trade repository and supervisory data to monitor certain NBFI activities. But data gaps will still exist, and in this regard, FSB and AMRO are very well placed to leverage upon its expertise and play a more constructive role in closing data gaps in the region. I also look forward to future research by AMRO and its affiliated institutions, such as the recently launched ASEAN+3 Finance Think Tank Network, on topics pertinent to regional financial stability. To conclude, the post-pandemic surge in indebtedness in the region and the higher for longer global interest rate environment are posing a number of new challenges to Asia's financial stability. Nevertheless, these challenges are surely not insurmountable if regional economies can join hands in tackling them. It is in these difficult times that the value of regional cooperation under the auspices of ASEAN+3 and other frameworks will really shine through. May I wish this forum every success, and let me just pause here. Thank you very much.